Well, for more on the Fed's decision, let's bring in Principal Global Investors Chief Global Strategist Seema Shah and Wells Fargo economist Michael Pugliese. Thank you both for joining us. So first, I want to get your reaction, Seema. 75 basis points, largely what the street was expecting. But what are you keeping an eye on? What are you hoping to hear from Fed Chair Powell later on?
Thanks. Well, I think we need to hear what is his tone, right? Is he going to continue to be hawkish? Does he mention anything about trying to force the unemployment rate higher in order to reduce inflation pressures? The dot plot and the summary of economic projections has given us a good hint at the kind of state of Fed hawkishness. It seems actually to be beyond actually even what the market was anticipating. But I think we're just looking to see further color, see how they are considering the labor market, and just a hint of how much further they really need to go and how long they need to hold rates for.
And Michael, your reaction now to the 75 and, of course, the 4.6 Fed funds rate by the end of next year.
Yeah, I mean, it comes across to me as hawkish. So I think even more than the 4.6 at the end of next year is the 4.4 for this year. I mean, that implies a pretty substantial amount of tightening through the end of this year, probably, something along the lines of another 75 in November and maybe 50 to end the year. So when you think about how we began this year, right, the Fed was still buying bonds at the beginning of this year. We're now talking about a 4.5% Fed funds rate at the end of this year, and then sustaining that all the way through next year and well above neutral through 2024. So, I think it's very hawkish. It's even more hawkish than the market was priced for, and it had moved quite a lot in recent weeks. So I think it just goes to show that Chair Powell and the Fed is putting its weight behind this inflation fight.
And that's a big reason why we're seeing all three of the major averages now in negative territory. The Dow off 142 points. Mike, just in terms of the strength of the economy right now, is the economy going to be able to absorb this aggressive of a Fed?
I think it could absorb it in the near term, but we put a recession in our forecast all the way back in June. And so we've been looking for a 2023 recession starting, spring, summer of next year for a few months now. And I think the case for that is really only strengthened. I mean, there's some near-term momentum here as gas prices have come down and consumers have continued to lean on their pretty healthy balance sheets to sustain consumption. But the question for us really is, how long will that last? I mean, month in, month out, as the weeks turn to months, turn to quarters here, in the face of this much tighter monetary policy, in the face of the fading fiscal policy stimulus that we got last year, earlier this year, will we still be in such a robust economic environment 12 months from now? I think the answer is no, and I think you're starting to see that reflected more and more in the Fed's own economic projections.
And Seema, what's your take on whether or not we'll hit a recession and whether it will be perhaps this year versus next year?
So I don't think it's going to be this year because, as we just heard, consumers have been generally quite resilient. And of course, the labor market especially is extremely tight. It's very unlikely to see a recession when the labor market is as robust as it is now. But I do think that what the Fed is essentially trying to do is almost engineer a recession. It's almost the only way that they would be able to push down inflation. When we think about recession, yes, they keep going until they have raised the unemployment rate sufficiently. And unfortunately, that implies that a recession is almost inevitable, I think, next year.
Okay, Michael. So is there any concern that there was just too much, too fast at this point by the Fed, not letting the medicine take hold?
Yeah, I think there's concern there. I mean, monetary policy, somewhat famously acts with long and variable lags. But I think the way the Fed thinks about it is, inflation is still so high at this point. If inflation was 3% or 3.5%, I think they might be willing to look at it a little more symmetrically and say, well, that's only a point and a half above our 2% inflation target. Let's digest this pace of tightening. But when you're running at, an 8% year over year and 6 or 7% on a 3-month annualized rate through core inflation, and when it's been this high for going on a year now, I think the Fed looks at this as no longer a symmetric situation. And so you certainly run the risk of going too far too fast, but I don't think the Fed is there yet, and neither do we. I think there still needs to be more policy tightening to get this inflation in check from what is well above the 2% inflation target where we are right now.
Seema, just your reaction on what we're seeing play out in the bond market right now. We have the 2-year rate here surging to 4.11. Obviously, the 2-year most closely tied to Fed policy, what we could potentially see play out here in the economy over the coming months. Just what's your assessment of the strong move up that we have seen in yields, especially at the shorter end of the curve?
Right. Well, I think it has to be expected that this kind of move would happen when you see the Fed as aggressively hawkish as they're conveying in today's decision. From here, we think that there could even be further movement up on the 2-year if inflation continues to be extremely stubborn. But I mean, on the 10-year point, we think that it can stay relatively elevated, kind of where it is today. But then as you get closer to that economic weakness really starting to come through, and recession comes into view as well, at that point, you could see some downward pressure on 10 years. But at this stage, there's very, very little to push it down as long as the Fed is hiking and the economy stays robust for the time being.
And Michael, speaking of robust, as we look at the sector action, it's really only consumer staples now in the green after this announcement of the 75 basis point hike. How important is the consumer going to be in terms of what happens going forward, especially when you look at things like earnings?
Oh, I mean, it's tremendously important. Consumption is 2/3 to 70% of the U.S. economy. And so, that remains the big engine here as you've seen other parts of the economy, be it, residential investment, or obviously there are a lot of problems abroad when it comes to global growth. And, consumption has been really remarkable when you think about all the challenges we've had this year, starting with the Omicron COVID wave back at the beginning of this year, over the winter, through, of course, the commodity price shock that we got and just the inflationary pressures more broadly, and the many hurdles that consumers have had to jump. We've still seen decent real personal consumption growth. But of course, that has been sort of on the back of this very strong labor market. Month in, month out, we've been adding hundreds of thousands of new jobs a month. I think the question really going forward is, as those tailwinds start to fade, as you're not seeing job growth like that, if unemployment rises next year like we expect and like it sounds like the Fed expects, is it really realistic to expect consumption growth to remain very robust? I'm a little bit skeptical.
And Seema, what do you want to hear from the Fed chair today? And specifically, how do you think he'll address the pain ahead for the labor market, to Michael's point?
Well, look, I think we have to think about this. For the Fed, this is going to be a very, very difficult time. And certainly for the U.S. economy, it's going to be extremely challenging. But they need to hike rates very aggressively now in order to ward off an even worse scenario later on. So in a way, I think what we're hoping to hear from Powell is almost him invoking his inner Volcker. And talk about the inflation fight, something that it is pernicious. It has to be done, that they need to achieve this price stability. And I think by doing that, unfortunately, along the way, that does mean that the unemployment rate is going to rise. And they have to acknowledge that there will be pain, but it's something that they have to go through in order to hit that price stability target, which is of the utmost importance.
All right, Seema Shah, we will check in with you in a little bit. So if you could hang with us here. Michael Pugliese, thanks so much for joining us here this afternoon.